Hey guys, it's Walker Deibel, author of Buy Then Build and creator of the Acquisition Lab. One of the most important components post-acquisition, after you buy a small business, is actually getting right the cash flow management. Cash flow management is probably a lesson all in itself, and sort of like the key in terms of what is going to get that part right for you at the beginning is working capital. And sometimes working capital is included in a transaction price, and sometimes it's not included in a transaction price. So I wanted to take a minute and discuss working capital and understand why it's important. So what working capital is essentially it's the amount of, let's call it cash, that's needed in a business in order to operate, right? So the sort of highest level working capital is going to be, accounts receivable, meaning, revenue that you've invoiced that has not come in, minus accounts payable, meaning things that you've been billed for but you haven't actually paid yet, plus the amount of inventory that's in the business, okay? And inventory you think of as an asset, but the truth is when it comes to cash flow management, it's actually a liability because you need to be buying that inventory at all times. And so managing the working capital is really just like sort of like having gasoline in your car. You need to make sure that there's enough gas in the vehicle for it to drive. And so accounts receivable minus accounts payable plus inventory is that working capital number. And if you're undercapitalized, then you'll sort of find that, after you acquire a business, you've got to come up with more money to put into it so you have the appropriate amount of working capital. There's a few ways that it gets done. So the way that I just described is probably the most common. And the reason for that is that most acquisitions are, in the sub $25 million market anyway, are asset purchases, meaning that the buying entity is acquiring the assets of the business, and not the stock or the equity like you would in the publicly traded markets. Okay, and so you've got a new legal entity that's buying the assets of the operating entity, and when that's acquired, it's what's called a debt-free, cash-free transaction. And what that means is that all of the cash that's in the bank accounts of the seller stays with the seller. All of the debts or liabilities that are with the seller stay with the seller. You obviously don't want to, well, you'd love the cash, but you don't want the liabilities or debts that they've had, right? And so it's a cash-free, debt-free. And so the way that you sort of look at, working capital is going to be accounts receivable minus accounts payable plus inventory. In a stock sale, it's a slightly different calculation, and it's more, current assets minus current liabilities. So I won't drill into that here, but it's basically all of the current assets like cash and accounts receivable minus all of the current liabilities or short term. So it's a little bit expanded than the simple AR minus AP plus inventory. But then the thing is that sometimes, and this is where it gets complicated, institutional investments like private equity firms, when they go out and acquire a business, and they sort of say like, okay, here's my offer on this deal, they then establish a working capital peg that has to be included in the transaction, okay? So if you're gonna buy, let's just say, a $25 to $50 million company, they're gonna, the purchaser needs to peg what that working capital is, and it needs to be included in the transaction, just like gasoline in the car, right? So in other words, they might say, okay, we're gonna pay you, let's pick a big number because it's a bigger acquisition, 6 times, adjusted EBITDA. But in that, what we need is this working capital peg. And the working capital peg is most commonly calculated by basically going through and looking at what's the AR minus AP plus inventory on a monthly basis for the trailing 12 months and then averaging out what that is. And that's typically what's included. It can be negotiated up or down if the working capital is kind of ramping up, then someone might ask for a little bit more to make sure that they succeed after they buy. And as a seller, you need to be prepared to sort of include that or gift that, right? Now, in smaller transactions and Main Street transactions, it's not included at all. So you go out and you buy a company for 3 times seller's discretionary earnings, and then it's sort of up to you to sort of add the AR minus AP plus inventory. And it makes a lot of sense because it's a smaller business. It is going for a multiple of seller discretionary earnings. as opposed to adjusted EBITDA, okay? And so adjusted EBITDA, there's another video where I go through the different types of earnings. So if you don't know the difference, please go check that video out. But the point here is when is it included and when is it not, right? And the thing is there's no textbook. This is an unregulated industry, okay? Completely unregulated. So there's a certain level of, as a buyer, what can you get the seller to agree to, right? However, I think the big takeaway is really just understanding, is this something that you're going to include in your offer or not? Sometimes you look at the seller's discretionary earnings and you look at, okay, what is the multiple, the valuation? What is the multiple of SDE? But what is the multiple of SDE with inventory, okay? Or what is the multiple of SDE, plus the working capital component? And then when you look at a different institutional transaction, it's going to be a multiple of adjusted EBITDA. And now the multiples are usually higher, okay? But the multiples usually include working capital in them. And so, of course, there's going to be this kind of gray area where, let's just call it loosely somewhere between, maybe as low as like a $5 million transaction all the way up to, a $25 million transaction, which would be really small for a private equity firm or institutional capital. But you get these search funds coming in, right? You get private equity that kind of dips down into these, smaller companies for tuck-ins or roll-ups or whatever it is that they're doing with their strategy. And their offers will come over and say, listen, we're going to go ahead and pay a 5x for this, a 5 times adjusted EBITDA, but in there we need the working capital peg kind of included, right? So anyway, that is the what working capital is. That's why it's important, and that's how it's included in a deal. Hope you enjoyed this video. If you are looking to buy a business in the next 6 to 18 months, we built the acquisition lab to try to help people like you with world-class instruction, a suite of tools, a vetted community, and ongoing coaching. Currently at 4 days a week, soon to be 5. Hope to see your application soon. Thanks so much.